Equity markets are witnessing their first meaningful correction since March 2020 amid a geopolitical crisis. If the Ukraine-Russia crisis turns out to be a prolonged affair, commodity prices will stay elevated for a long time. Clearly, this will have an impact on the domestic inflationary scenario, where there already are significant undercurrents due to increasing pass-through of higher commodity prices with improving demand in manufactured products and even services. All of this, analysts say, may move investors from equities to gold or real estate, as the two could prove to be great hedging bets against inflation. Emerging data are also backing that rationale. Consider this: gold has emerged as the best performing asset class so far in 2022 after underperforming most risk assets last year. The yellow metal is trading above $1,900 per ounce in the international markets and is at its highest level since June 2021. On the bourses, the metal is up over 4% year to date against a 2 to 5% fall in major equity indices globally. According to Chirag Mehta, senior fund manager at Quantum Asset Management, gold is set to benefit in the near term as risk-averse investors would increase exposure to it amid pullbacks in risk assets. Quote, however, in the event of this conflict getting extended, we are looking at more money printing to fund military actions, higher energy prices, and economic sanctions against Russia. All these will fan the fire of already high inflation, take a toll on slowing economic growth, and spur market volatility and risk aversion. This environment will be supportive of gold prices, but will eventually clash with the Fed's tightening cycle, which is expected to keep gold prices in check. Expectations of higher interest rates will not only spur buying in gold, but also in real estate, as investors may choose to invest in properties before the rate hike cycle kicks in, says A.K. Prabhakar, head of research at IDBI Capital.
Yeah, in short to medium term, yeah, gold can be a good asset class, but not more than 6 months or 9 months, because after a very long time, gold has performed. So and we have interest rate hike which can happen globally, so that will have a negative impact on equity. So yeah, now you will have gold outperforming, or other metals also outperforming, but these are for short to medium term, not for a long term. Rising interest rate will have an impact on real estate. So whether where you buy the real estate is also very important. If you are buying in new emerging place, then your real estate can do very good. But already something which is very developed, where the potential returns will not be great.
HDFC Securities says that the real estate upcycle is driven by rising income levels, narrowing of the rental yields, and interest rate corridor gap, market share gains by organized players, and confidence in strong economic growth. Quote, these tailwinds are favoring a real estate revival and have led to an unprecedented pickup in sales. A large share of household savings is being directed into home purchases, which could lead to disproportionate gains for strong branded players. Unquote. Anurag Group Chairman Anuj Puri told Business Standard that 80 to 85% of home buyers are end users now. With new supplies reaching pre-COVID levels in 2022, real estate prices may rise by 5 to 10%. Overall, mid-end and high-end housing segments will continue to drive demand. That said, analysts caution against tweaking portfolio construction amid event-based risks and suggest changing the exposure mildly to ride the volatility.
One should not really start looking at other asset classes just because one of them is underperforming. Basically, one should have gold, real estate, and infra exposure via REITs or InvITs, fixed income, equities in varied proportions. And in times like these, one should be tweaking the exposure rather than really overhauling it. Equities may be flattish or a bit negative over the next 12 months, but I would really see this as a great buying opportunity at lower levels. Gold hasn't performed in recent times, but one should have an exposure of about 5 to 10% of the portfolio, because I expect that it could outperform in the next 12 months as we brace geopolitical uncertainty going ahead. Buying individual property as an investment for regular returns or appreciation may not really work this time, unlike what we saw 15 years back. One may buy property for self use, but excess funds in that bucket, I think, should be deployed in real estate instruments like REITs and InvITs, which I had mentioned earlier.
Over the long term, equities have proved to be the best performing asset class. According to a report by Credit Suisse Research Institute in collaboration with London Business School, in the past 122 years, global equities have provided an annualized real return of 5.3% in dollar terms, compared with 2% for bonds and 0.7% for bills. Thus, diversification across stocks, countries, and assets greatly improves the return-risk trade-off.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.